Oops, that's not what we wanted. All right, so first cover cost segregation, and then we're going to cover short-term rental loophole. So let's just start with an example. There's cost segregation, which is the study, and then there's bonus depreciation, right? Those are the two things. Cost segregation is just the study. You go out and you hire Bob or one of these online cost segregation companies, and they will do a cost segregation study for you. All the study does is it breaks down your depreciation. So standard on a single family home, you're going to depreciate the property over 27.5 years, everything, right? Except for the land. When you do a cost segregation study, you break out the items that per the tax code, you're allowed to depreciate on a faster time period. So you're breaking out items that I can depreciate over 5 years, 10 years, 15 years, whatever the actual numbers are. So on like large commercial, before bonus depreciation was ever a thing, they used to always do cost segregation studies because in commercial it's 39 years and they didn't want to wait 39 years for every single component. They want to know, I want to write off my roof in 10 years. I want to write off my furnace in 5 years because you're getting the benefit of the depreciation tax write-off quicker. Bonus depreciation is this new things where it's like, well, all those items that you just categorized as 5, 10, and 15, you can take them all in year one. That's what changed. It's like these 5, 10, 15-year categories, you can take them up front. You're welcome. So now you got this massive tax write-off right up front. Then you know how it was tapering off, right? That's 100%. Well, now it's if you add up all your 5, 10, and 15-year items, you're whatever that number is, say that's $20,000. You're allowed to take 80% of that number. And then, oh, last year was 60% of that number or 40%, whatever it was. That's the cost segregation bonus depreciation. Let's just look at a number. So on a single family home, $100,000 house. This will probably be easier than me talking. $100,000 house. My purchase price is $100,000. You only depreciate the real estate, the house, not the land. So this is sitting on this is a $100,000 house, and it's sitting on a point.
Do you guys see the 100? Oh, there it is.
Okay, I just put $100,000 in the purchase price. You only can depreciate the house. So this is sitting on a 0.1 acre lot, right? That's what a lot of our little rentals are sitting on. If it's something sitting on a 1 acre lot, you might have to use a different number. You might only be able to use 80% for this number because the lot itself is worth 20% of this $100,000 price. But I know that on a $100,000 house, my lot, if my house didn't exist, I'm only selling that lot for $10,000, right? So my value of my property is 90%. So now, normal situation, $90,000 will be written off over 27.5 years. This is standard real estate depreciation. This alone is what makes real estate such a great investment because every single year you can write off $3,272 as a loss. So just because it's real estate instead of W-2 income. So it's just a paper loss that if you were making $5,000 in cash flow, say you pocketed $5,000 in cash flow, you get to say, yeah, well, I have depreciation of $3,272, and you're only going to pay taxes on the $1,700, $1,800 left over. So you pay taxes, you pay your 25% taxes on $1,800. That's a steal. If you made $5,000 in your W-2, you pay 25% on $5,000. It's much higher taxes. You're saving a lot of money here. So if you do a cost segregation, this is an estimator tool right here, right? All we're doing is estimating. You have to do the actual study to find out what this number is. However, on single family homes, yield this 20 to 35%. This is the sum of those 5, 10, and 15-year items. So if I do my cost segregation study and I get, I got to find the example. This is going to take a second, but okay, here's an actual cost segregation study. I'll share my tab. It's not sharing. I'm going to break this down really simple. It's right here. If I zoom in. So this is a single family home that I bought for $80,000. The cost segregation, he broke down 5-year, 7-year, 15-year, 27.5-year items. So let's just find one. So my woods, plastics, and composites equals $4,589. My finishes, all this stuff, trying to find it, he broke down. And then my 15-year earthwork, exterior improvements, whatever I don't even know what that is, but I don't have to. That's what I paid Bob for.
Plastics and
yeah. What it is your floor, it's your furnace, all those things.
Yeah.
So my 5-year items equals $38,000. My 15-year items equals 40,000. Yeah, I think I'm looking at the wrong number here. Why are these numbers so high in the bottom? I don't know where he's getting $201,000. I think I should be looking. It's these over here, these non-depreciable basis cost segregation studies. These are the sums that I actually want on this side over here. 5 years equals 10,000, 15-year equals 4,000, 27.5-year equals 57. That equals my $72,000. I bought this house for 82,000. What I'm able to depreciate is 72, right? Remember, because the land is worth the other 10. So this is more like 15% allocation to land and 85 to the property. So what you get to do, your yield is the 5-year and the 15-year added together. So 10,834 plus 4,164. What's that? That's 15 grand. So $15,000 divided by $72,000, that's a yield of 21%. So of the $72,000, I get to bonus depreciate 21%. So now let's go back to the calculator. Okay. I would put a 21% right here. 21. Technically, we used 85% on this one. I don't know why. I'm pretty sure I told him to use 90 on all of them, but this is what we did. So 85% for the property, 21% of this $85,000 was 5 and 7.5 years that I can push forward. Oh, sorry. Okay. Right here. 85%. I'm putting in 21% for my yield. And I just know, like, this is an actual state study. If I'm doing a single family home, I'm going to put 25% for my estimator. Probably going to be a little more optimistic when I'm estimating. I might use 25. I'm definitely using 90% if it's a small lot. So what that means say I bought this one in 2022, which means I did get to use 100%. If you buy a house in 2025, you get to use 100% again. So I can keep my 100%. That means I get to use all $17,000. So this means right now, this property is going to cash flow $5 grand this year, whatever. But I get to show an $18,000 loss. So that means I'm negative $13,000. So what does that mean as a real estate professional? I get to take that $13,000, and if I made 100 grand as a realtor, boom. Now I get to show the government that I only made $87,000. So I'm not paying taxes because of this. Yep. On just this one property. I did 17 of these in 1 year before. And so I got to write off 20 grand times 17. Do the math. I didn't pay taxes that year. So now you use your personal tax bracket. So whatever is your marginal tax rate, I don't know what we're all paying in taxes, ends up being 25 to 35%. You just use your average number, throw in 30%. So that means if I made 100 grand and normally I'm paying $30,000 in taxes, I get to wipe out 17,850. That means it's $5,000 in my pocket. Plus I paid Bob $1,000. So this cost segregation study put $4,000 in my pocket on an $82,000 house. What's that? Kept it. Instead of paying, that's a better way to word it. Instead of paying $4,000 in taxes, which I would have paid, I got to keep $4,000. And since I'm paying like estimates and stuff, sometimes you do get money back. If you're Richie will never get that, but
I have yet to pay any estimates.
Yeah, me neither.
yeah.
Are
So-
you not nervous on January or when you file your taxes?
The way that my accountant explained to me is you can think of it as a small loan.
We do get hit with fees.
Yeah.
There are fees for not paying the quarter.
But if your strategy, though, in theory, is that you're not going to pay any taxes, then
Yeah, then it makes
not
sense.
paying the estimate.
no, if it wasn't for my wife, I would do the same thing.
Yeah.
Because I would just be buying real estate and paying my fees.
Having the cash in my account though makes me more bankable.
But-
it makes it look better for the lender.
That makes sense.
This is the secret to how I can say I did not pay taxes. For 1 year is the caveat, right? But $18,000 times 17 studies, that's $306,000 write-off.
And
So
you don't have to use that all in 1 year.
It rolls over if you don't use it all. So now, and I even had bigger properties. I didn't have all $80,000 houses. I had a couple bigger properties in here. So I had a $306,000 loss I put on my tax return. My accountant did. I didn't pay taxes. Now I could dye my hair pink and go on and do a reel and say, this is how you don't pay taxes. Caveat is I don't know how to do it a second year. I only know how to do it once because now I don't have any more
Is
houses.
there,
Well, that's the
is there
trap.
you guys switch the flips for apartment buildings? Because like
What's that?
I said, is there any like maybe for short-term loophole and all that stuff? Is there anything like for apartment buildings when you've got
Somebody is going to be a real estate professional if you're buying,
that's what I'm
if
saying.
you're partnering on a large apartment building.
Some of these guys who are buying this aren't doing it. Are they just saying they're full-time multifamily operators?
Yeah.
Because I just am not convinced that.
That they are real estate professionals. I think they check, all it is a box on a tax return. Real estate professional is a check mark. And I think a lot of people commit fraud. I think they check the box and
Yeah.
they hope they don't get audited, just like everybody, a lot of people do.
I have a question about this that I'm still confused on. What happens if you sell the property?
You got
Okay.
to recapture.
Recapture. So it depends on how long you've kept it. If you sell it after 28 years, it's nothing. If you sell it after 2 years, there's a math equation that I can't explain in this video. That's like, well, you only get to use 1 year worth of it. The other percentage you have to pay back. So I wrote off $18,000. If I sold it in 2 years, I would owe back $15,000 of a loss that I wrote. So I'd have to put $15,000 in profit
As
back on my
additional
tax
income,
return
yeah.
as additional income. And now I'd be paying $3,000 in taxes owed back. So don't sell 1031 tax exchange or hold it for 30 years is essentially.
Gotcha. But the recapture is basically whatever losses you took. I mean, it sounds like it's not
The
one.
difference.
for
It's not one for one.
It's-
Yes.
But
And you're
safe to assume that a large chunk of what you. wrote
Yeah.
off
if you sell it
will
quickly,
back.
if you bonus depreciated and took 100% and you sell it within 5 years, you're going to owe most of that money back.
But if you wait 5,
What if you wait 15?
It's going to be a much smaller number. And so
Joe's not a
It'll just be
CPA.
the-
It's going to say.
I'm not afraid of that. There's no disclaimer on this. Take my advice.
Buy a house with me.
that's the only thing. It's the portion of the 27.5 that everybody's.
Still confused.
I think
You're only accelerating the 15 years
Okay.
of depreciation. So once 15 years has passed, Now it's just the 27.5.
So what's being recaptured is only the bonus?
Yeah, whatever you
Correct.
accelerated.
Okay.
No,
What was-
Well,
it's all depreciation you
Yeah.
took.
It's still the 27.5.
Yeah.
So let's say, let's say you didn't do the cost segregation and the bonus.
Right. You got $3,272 that you took as a write-off your first year.
Yeah.
If you sell that year 2,
Yeah.
you're going to owe some sort of percentage of that $3,000 loss back.
Okay. And that extrapolates to, let's say if it's year 15.
Year 15, you took 3,000 times
Every year.
15 years.
Every year.
Yeah. Now it's not going to be crazy because of the equation,
Yeah,
right?
Yeah.
It's going to be
Probably the longer you go, the less.
Yes, it's 100%. And I think that's the only concept you need to know.
Yeah.
It's like if I sell quick, I'm going to owe a decent chunk back. So here's what it is. You took $3,272 as a loss, which means you didn't pay taxes. You didn't pay 25% taxes. That's $800. If you sell it year 2, you're going to owe like $600 back to the government, whatever it is,
Yeah, it's the same. It's the same if you sell a house quicker than 28 years. You just haven't accelerated the other stuff.
If you sell it year,
It's still the depreciation you've been
Yeah.
doing it right.
Right.
You just
So-
normally, without accelerating other stuff, you're still writing off the 27.5 years.
Yeah. Right.
So if you sold it before the 28, there's still going to be some recapture,
Yeah.
but it's a smallish amount because of
2 big pieces to this. For this one, you have to be a real estate professional, which we really probably should break down the requirements. We'll do that at the end. And then you still get what's left over, right? We had an $82,000 house, $82,000, and we bonused. This is saying on this right now, what I have it as is 18,900. So if I take away 18,900, I still have $63,000 that I get to add on over 27.5 years. So I get to take $18,000 year 1 and then $63,000 divided by 27.5. I still got $2,300 every single year. So years 2 through 27.5, I get to throw down $2,300. So bonus depreciation, so many people are like, oh, I like the ongoing write-off. You're still going to get it. It's just going to be 20% less. But time value of money, take the $4,000 in your pocket right now, do this on 5 houses, and you got another down payment for another property. The faster
So
you
this
get
is why the commercial guys will just buy it, depreciate it, and then 1031 a year later.
Yeah, right. Now,
They don't
when you're
need the cash
1031ing, you have to subtract out what you took. So if you took out, $20,000 and I 1031 in this next one, I think it's like my cost basis is $20,000 lower on the next house. But you bought a bigger house. You bought a $50,000 more expensive house, and then you have to take away $20,000. So it's like you only bought a $20,000, $30,000 more house.
Gotcha.
Just understand the basic concepts. Your CPA has to do all the math. But yeah, you purchase price is $1 million on this. These numbers all are pretty drastic because you're going to probably write off a bigger yield. So you buy $1 million house, you're putting $80,000 back in your pocket. You're getting a $270,000. So if you're a doctor that makes $270,000 and you buy $1 million apartment building, and you can somehow figure out how to call yourself a real estate professional, your wife is a real estate professional, and you're the doctor or your husband, and you're the doctor that makes $270,000, you will pay no taxes that year in real estate if you buy $1 million apartment complex.
You could bonus depreciate your cars and equipment too.
So on
That's
the total ROI sheet, when it talks about tax benefits,
The total ROI sheet, the tax benefits, is only referring to the 27.5-year depreciation. It's assuming you are just taking regular 27.5-year depreciation.
Okay.
TurboTax will automatically calculate for you.
Yeah.
You don't.
so the only tax benefits that it's outlining in the total ROI sheet is your ongoing depreciation.
If you don't do cost segregation.
Yeah, just your standard normal. Yeah. Exactly.
No added losses, no anything. That's just the depreciation.
So yeah, that's the math on that sheet.
Just normal.
which is true because if you made that money any other way, you're not getting that write-off. That's
Yep.
why real estate, we count it as an ROI because that's the benefit of real estate. So count it. It's fair.
If you're doing TurboTax or anything, and they just say, "Do you own a house?" You go, "Yeah."
Yeah.
It's gonna calculate. it.
Right. So short-term rental loophole. The math is all the same. It's just, you don't have to be, what is it? If you buy a short-term rental, it only applies to short-term rentals because short-term rentals are considered more active income. And so short-term rental doesn't make you a real estate professional. It's just another method of being able to do bonus depreciation. It's an easier threshold because you don't have to show the same amount of time as a real estate professional does. So you can go buy your $350,000 short-term rental. I'm a what is it? The short-term rental it doesn't have to be your primary gig, right? It just has to be more than anyone else.
Correct. It's like
Right. So
100 hours or
so
something.
you're a doctor and you make $200,000 a year. And you buy a $350,000 short-term rental, but you're a full-time doctor. But you can prove, and we'll look at the requirements, that you meet the requirements to be able to pull this off. Now you get to show all this same math. I'm going to use 25%, 90% for the property. I better use 85. No, I'm going to use 90. 25% yield, 100%. My personal tax bracket is 35 because I'm a doctor. And I do this. I make, how much money did I say they made? 250 grand. They get to show an $80,000 loss, which means they only are going to pay taxes, not on $250,000. They're going to pay it on $78,750, which is going to bring down their taxable income down to $171,000 just by buying an investment. Instead of putting your money in the stock market, you buy a short-term rental and you get to discount your. So now let's look at, sorry.
No, now I'm just thinking. So now is that I guess that's short term. Calculating first.
So how do you meet the requirements to be able to check this box? Oh, you guys can't see my screen. I typed it in a Grok. What are the requirements for a short-term rental loophole? Unless, Kayla, do you have them written down already? Exactly.
Yeah, let me send those.
You can share your screen if you want. Let me just see how accurate this is. No reps needed, right? You don't have to be a real estate professional because you're claiming the short-term rental loophole, which means that you can take this bonus depreciation against your regular income if you meet this. Average period of customer stay, 7 days or less. That's going to be met. That's a short-term rental. Material participation tests. You have to participate. You participated more than 500 hours during the tax year. This isn't hard, right? Did you help furnish it? Did you help find it? Did you help anything? I mean, be generous with yourself and show 500 hours. That's not that hard. If you're self-managing your own short-term rental, this is easy. You're going to hit this 100%. If you're using another manager, this will be a little bit trickier. You're going to have to help with some furnishing or somehow figure out how to show the 500 hours. Isn't it? You only have to be one of these.
It says at least one.
Where does it say that?
Sorry.
Okay.
It's
Yeah.
bold.
Okay. So at least one of these. So 500 hours is easy. It says number 3 is another one. You participate more than 100 hours and your participation is not less than any other individuals. It's going to be hard to show if you're using a manager because they might be able to show that they did more than 100 hours. So maybe you get involved with communication or something like that. If you use a co-host, so I have 2 short-term rentals. South Dakota, I have a property manager. Oklahoma, I have a co-host. The co-host, I'm I'm technically the main host and I have a co-host who does all my responding. However, if I was trying to show that as material participating, the co-host route would be much easier because I see everything. PM, it's really hard for me to argue because I'm not involved with anything. The co-host, like I see all the communication. I could be like texting my PM all the time. Like, hey, do this, do that. Be a pretty easy way to rack up hours, use a co-host and be involved. But yet at the same time, in reality, I don't have to be that involved. She does everything for me. I could just show I was more involved.
I want to talk about how you found that co-host after this.
Yeah, we'll talk about that. That's it, right? I met one.
Gray area.
Yeah, on recording. Is that what you're saying? Come after me. I'm a rep, so I'm okay.
Oh, yeah.
It's just my advice that gets me in trouble.
Yeah.
He's a rep. He's not a.
Either way, you're right.
I'm fine, yeah.
Yeah.
But
Well, that's just what an extra.
yeah, I'm doing co-host because I like the transparency. I like being able to see what they're doing.
Okay.
And it was honestly, it was all I could find, but I actually prefer it over the
Somebody
PM.
who's non-reps that might be
Yeah,
a good route.
because also I get to keep all the reviews for the property on it's my Airbnb account. I'm getting all the reviews. So if I change co-host, I keep my reviews. My PM, the reviews go with the PM because they're the co-host, they're the host. Kayla, does that match? I don't know where you sent the notes. Does this match what you had or sent?
Yeah, it does.
Okay.
So
So-
technically you just participated for more than 100 hours and nobody beat you.
That's
Yeah.
one of your options.
That's
And
way easier than 500 hours.
Yeah, but if you're not self-managing, you're going to get beat. If I have a PM or a co-host, it'd be so hard to prove to an auditor that I spent more hours than my co-host did. That's the tricky part.
And you think it's possible to hit 500 hours if you don't self-manage?
Yeah, it's 10 hours a week. I'm gonna log 100 hours in my furnishing and cleaning up, and I'm gonna do some painting, get involved. So I'm gonna knock out a major chunk on the getting it ready to rent, which I think is legal.
Well, what about if you do this so you can do the bonus depreciation, but then you hire a PM after year 3 and you're not logging it? Does that matter? If you're not, if you use this STR loophole to do the bonus depreciation up front, but then you stop qualifying for it by year 3 because you hire a PM and you step away,
That's a good point.
do you have to hold that status for the Grok might be able to?
Kayla shaking her head, yes.
I was shaking my head. Yes, that's a good point. Not because I know.
Oh,
Yeah,
that's
I mean, it makes sense. It's only applying to the year that you're.
I think there's going to be a caveat, and I kind of vaguely remember this from Matt's tax guy that you have to continually do it and prove you're doing it for like 5 or some X amount of years. 5 out of 10 years. I think you materially participate in activity for any 5 of the prior 10 tax years.
That's only one of the things you have to do.
Yeah. I think
Ask Grok, say for how many years do you have to meet one of these requirements for bonus depreciation?
I'm trying. One other thing that I was thinking of, if you're trying to meet your 500 hours, if you're buying a short-term rental, like the way I'm buying it, I'm buying in areas that I like going to. I go out there for 1 to 3 weeks a year. That's a tax write-off for me, that traveling out there, because I'm working on the property, right? I'm going to log all my fixes. I'm cleaning that carpet. So I'm logging 80 to 100 hours anytime I go out and visit my properties, which bam,
Baseboards, right?
baseboards are clean, man.
Baseboards.
I got text message proof that
Go up under the keynotes examples, camera test. That's funny.
camera test.
Spouses count jointly.
You should. I don't
If you
log them.
file
If I
them.
get audited, I'm going to create my
If you
spreadsheet.
file jointly.
So
That's on video.
Gotta be
so
an app.
screwed. Someone's going to report me and send them the video. Someone doesn't like me. Screwed. I could pass an audit.
It says spouses count jointly. So that means that that 500 hours has to be between spouses.
So we don't.
Right. So you and your spouse get to each spend 80 hours every time you're out there. That's 160. Okay. What was the question I was asking?
How long do you have to keep?
How long do you have to meet the requirements? For example, 500 hours a year, is that only year one? Come on, Grok.
Every but that's crazy. Always less than.
Must be met for each tax year you want to claim the short-term rental activity as non-passive. I mean, hey, that sounds like only 1 year.
The loophole is often most lucrative in the first
But
year.
if that's every year you claim the loophole.
Only claiming it for the first year. What happens if I don't claim it the second year?
Subsequent years, you must continue meeting the requirements each year. Hmm. Interessante.
I don't think Grok likes 3 questions at once, but we'll see what happens. No, you don't have to meet the 500 year every year.
Nice. If you meet it in that year.
To continue classifying as non-passive activity,
Nice. Bonus depreciation is not clawed back or lost if you fail to meet material participation requirements in future years.
is not clawed back or lost if you fail to meet participation in future years. Once you validly claim benefits. So you only have to do this for 1 year?
Yeah. Rock
Fuck
on.
it, figure it out. I mean, just make it happen. Get your 500 hours. This is a no-brainer. If you make any type of decent wage and you're interested in real estate investing and you're not a real estate professional, the short-term rental loophole is a no-brainer. Buy the house,
Suffer
get it
for
closed. So here's another tip on short-term rentals. My Oklahoma house, like I had to put 50% down to make that thing work, right? It didn't cash flow at 20% down. South Dakota does not cash flow at 10% down. Like, so this is an incredible strategy, but you might have to do something different. You might have to do a higher percent down just to get this thing to break even. But because of that's just break even on cash ROI and cash flow. You're still getting the tax benefits. I make 20 grand a year in appreciation on South Dakota. 20 grand. Because that house goes up 3% every year. It's a $500,000 house. Don't check my math. So, anyways, brilliant. Should we post this in the Fire Team Clients Facebook group?
I know there's a lot of
Need some editing. Need to get an
audit
editor.
worthy stuff on there.
I am. I legitimately could pass an audit straight up. I do have extremely good bookkeeping and follow all the rules. Because my wife is pretty uptight about it. So anyways, we should post it.
Yeah, I
We'll
think
stop.
you just say, what do you guys think about this? And it's
Yeah.
less like, what do you think about what Grok just told us this morning? And then you're not like shoving it or like preaching it. You're just like, what do you guys think about that?
All right, cool. Done recording. How do I get it off record?